So at the start of the month, we had a mini crash in the US markets. Well, actually, it was not really a mini crash. It was actually the fifth biggest point drop in the S&P 500 in its entire history. So it was a big deal. And a lot of people panicked, as you know. Unfortunately, a lot of retail investors, they sold right at the bottom before the market rebounded. But hopefully, if you watch my videos, which I put out 2 weeks ago, about how to navigate the market meltdown, to stay invested, to hold the stock, and in fact buy more shares, you should be doing pretty well right now. So let's run through what has happened and to answer this question, which is, has the market bottomed as far as this pullback is concerned? So recall that what actually caused this initial sell-off in the markets? It was two things. Number one, the main contributor was the unwinding of the yen carry trade, which I've mentioned in my previous video and in my social media. And again, for those of you who don't recall, the yen carry trade is one where for quite a number of years, in fact, a lot of traders, they borrowed cheap Japanese yen at close to 0% interest rates. And this was like trillions of dollars. So they borrowed in yen, they converted to US dollars and other currencies and bought stocks, US stocks or emerging market stocks. And that was a great idea until the Japanese central bank suddenly increased interest rates and said, we're going to increase even more. So that caused the Japanese yen to spike up against the US dollar. So now people who borrowed Japanese yen, converted to US dollars, they were in big trouble because they're now losing a lot of money based on their currency losses. So what did they do? They had to unwind the position. So this forced many traders to sell trillions of dollars of stocks to get back US dollars, to convert back and to pay back the Japanese yen. So there was all this selling going on. It's like everyone rushing for the exits, and that caused a liquidity crisis. And so we had a huge drop in the markets. Many great companies like your Nvidia, your Meta, your Amazon, your Google, your Palantir, they all dropped. And I love these kind of crashes. Why? Because these are the kind of crashes where the price drops when it's got nothing to do with the business. There's nothing wrong with the business. The businesses are still making money. They're still growing their profits, their free cash flow. The price dropped purely because of some external factor. And these are the best times to buy these high quality stocks because these are the kind of sell-offs that don't last very long. That once this liquidity crisis is over, and everyone who wanted to sell has sold, it rebounds back very, very quickly. And that's exactly what happened. In fact, what happened was not only was 75% of the yen carry trades unwound, but the Japanese government freaked out. They say, oh my God, we will not do this again until we are sure the market stabilizes. We will not increase interest rates again, right? So once the Japanese government kind of like backtracked, the markets rebounded. And of course, to add to that panic, we had the SAM rule that says unemployment rate is increasing, recession, right? So the whole market crashed. And then what reversed it? The next thing you know, we had a new data point that said that unemployment claims were now dropping and that retail sales came in better than expected. So, hey, no more recession. Wow, the market goes up again, right? So I keep saying, ignore the freaking news because, news changes so fast. Just focus on the fundamentals of the business. As long as the businesses you're invested in are great companies, they keep making more and more money year after year after year, you stay invested in these companies and you take advantage of short-term bad news and short-term panics to add to your positions. So that's what I did. As you guys know, I did a video called Market Meltdown, What Should We Do? So when the markets dropped early this month, I was like, hallelujah, right? So I was like buying shares like crazy. I bought some Singapore listed stocks. I bought some of the Singapore banks. I bought a lot of Singapore banks. I bought more US stocks. I added more Lululemon, by the way. And at the same time, when the market has a panic and the VIX, the volatility index goes up, that's the best time to sell cash secured puts or put credit spreads. You get a lot of premium, which is what I did, right? And now that the markets rebounded, the volatility drops, these put options I sold become very profitable. And in just a few days, I closed them with 80 to a 90% profit at certain times, right? By the way, those of you who are subscribed to my UIP service, you get to see my live trades every day, right? So these were all the trades I closed just in the last few days, right? So for example, close Microsoft 385 put, 82% of max profit realized. Close Palo Alto 275 put, 83% of max profit realized. Close my Nvidia 90 put, 85% of max profit realized. Close my IWM bull put spread, 63% of max profit realized. Close MedPace 330 put, 80% of max profit realized, right? So it was a great opportunity to make some extra money. So year to date, you can see, for example, my portfolios are back to almost their all-time highs, in fact, right? In fact, I can show you. Let me just log into my account over here in full transparency. In case some of you are saying, you show your profits, not your losses. How about everything? Okay, here's everything, all right? So year to date, my portfolio is up 14.98%. It's still below the S&P, right? S&P this year is up like 16.4%. So I'm still trailing the S&P year to date. But I think by the end of the year, I should be able to beat the S&P. I should, right? Why? Because you can see that my portfolio, went down like everyone else's during that temporary drop. But now it's back to almost where it was. Whereas the S&P 500, as you can see, has, since the drop, it has retraced more than 50% of the correction. But it's not yet back to the highs. So once the S&P gets back to the highs, my portfolio by then should be even higher, right? So again, I'm just guessing, right? It may or may not happen, but hopefully it's going to happen. But on the 1 year time frame, which is the last 12 months, my portfolio is up 29.65%, which is above the S&P, which is up 26% in the last 12 months. So to answer the first question, has the market bottomed, at least for this particular drop? I think yes. Again, there are no guarantees in life because anything can happen. There are too many moving parts. But based on the price action, it looks like more likely we have bottomed for this drop, and we should see new highs. But we could again have another drop before the end of the year, all right? So don't discount that. So why do I think that we have possibly bottomed? A few reasons. The first reason is, again, some people may say that this is actually just a dead cat bounce before the next drop. Now again, of course, that's possible, but it's unlikely at this stage. Why? Because usually if you have got a rally on a bigger downtrend, it should rally to about the 50% or at the most a 61.8% Fibonacci retracement level. Now, if you put in your Fibonacci over here, you can see that the rally has already crossed the 50% and 61.8% retracement mark. In other words, if it was a dead cat bounce, we should have found resistance there and crashed back down. But we have broken above the 61.8% Fibonacci level, which means that it's less likely that we go back down, at least for this particular drop. The other reason is if you take a look simply at the moving averages, you can see that it has closed back above the 50 moving average, which is a pretty bullish sign. And the red line has crossed above this blue line, which is a 20 EMA crossing back above the 40 EMA. So usually when a 20 crosses back above the 40, that tells you that the short-term trend is now back into an uptrend. So in other words, the uptrend has been confirmed and we should see higher prices. But again, there's no guarantees. We have Fed Chair Powell speaking end of this week on Saturday. Right? There'll be 3 a.m. By the way, this is Singapore time, so you can convert to New York Eastern time yourself. We have got the Jackson Hole Symposium, where again, Fed Chair Powell, if he says something crazy, then of course the markets could reverse back down again. So hopefully he sticks to the script. Inflation coming down, I'm going to cut interest rates, then the market should continue going up. And of course, before that, we have got Other data points coming up we've got on Thursday. Again, this is Singapore time, 2 a.m., which is 2 p.m. Eastern time. And also on Thursday, we have got additional economic data coming out, which will be unemployment claims. That would again further confirm that the economy is okay if unemployment claims come in lower than expected. And of course, we have got flash manufacturing PMI and flash services PMI. So as long as they all come in within expectations, then the uptrend should continue. But of course, remember that the market will not go up in a straight line. And in fact, you can see historically during election years, from the August period to the end of October period, the markets should continue to be choppy, right? So you're going to have pullbacks along the way. And again, if you kind of like miss buying shares of great companies during this pullback, there should be a few more pullbacks along the way this year before we get our strong end of the year rally, regardless of who wins the presidential election. Although right now it looks like Harry's gonna win, right? Okay, so next let's talk about Google. What's happening to Google, and should we be concerned as investors? Now, to get you up to speed onto what's been happening, so a couple of weeks ago, in fact, it was reported that Google lost a landmark US antitrust case over their search dominance. So the Department of Justice sued Google for being a monopoly. And they said that Google engaged in anti-competitive practices to maintain their monopoly. And so they sued and they won the lawsuit against Google. So what did Google do to violate Section 2 of the Sherman Act, which is the act against monopolies? So they accused Google of being unfair because they're saying that Google, you are so powerful and you are retaining your monopoly because you are paying $50 billion a year to be the default search engine on number one, mobile carriers. So again, think about it. Every year, Google pays $50 billion to Apple, to Samsung, to AT&T, to T-Mobile, to Verizon, to Mozilla, to what's the other one? To Opera, to be the default search engine. And what the judge is saying is that because of that, users have no choice but to use Google. That's why you're a monopoly. But of course, Google is arguing and they're saying that no, people are using Google not because they've got no choice, not because we are the default search engine, it's because we are the best, right? But the judge said, no, right? You are unfair. So basically, Google lost the lawsuit. Now, am I concerned about this? And what does this mean for Google? I am absolutely not concerned for a few reasons, right? Reason number one is that I've seen this movie many times before. This was the exact same thing that happened to Microsoft. If you guys recall, in 1999, Google was sued for being a monopoly by the Department of Justice as well. And that was even more serious because at the time, the government said that Microsoft has to be broken up into many different companies. Okay? But what happened? Microsoft appealed, and a year later, they won the appeal, and their case was thrown out. So the appeals court reversed the decision, and Microsoft was no longer to be broken up, and they then overturned the antitrust ruling. So that's the one thing I love about the US markets. What I love is that the US government, their bark is worse than their bite. They bark, they sue, but in the end, they can't do anything. Because in America, money talks, right? At the end of the day, like it or not, politicians, they are lobbied by these companies with billions of dollars. That's why I don't like to invest in China, because in China, the government has the power to shut down any company. In Europe, there's too much regulations. The government has the power to regulate any company. But in the US, they appear to regulate, they appear to bark, but they've got no bite. That at the end of the day, my guess is that, first of all, once Google loses this case, they will appeal. It's going to drag for years and years and years, and in the end, probably they're going to overturn it, and Google's going to be like, yay, right? So that's likely going to happen. But you may say, Adam, what if that doesn't happen? What if they really appeal and Google loses again? Well, so what? So what's the worst thing the Department of Justice can do? Well, there are two things they could do. Number one, they could force Google to stop paying $50 billion to Samsung, to Apple, to T-Mobile to be the default search engine, right? They could do that. So if they do that, what does that mean? That means when you buy an Apple device or when you use AT&T or you go to Opera web browser, Google will no longer be the default search engine. Instead, when you buy a Samsung phone and Apple phone, they will tell you to select your default search engine. So you could select Google, Bing, or DuckDuckGo, or Yahoo, whatever it is, right? Now, chances are that if people were to select, they would still select Google. Why? For two reasons. Number one, human beings are very lazy. We are creatures of habit. We are so used to using Google, we can't live without Google. We'll still choose Google even though they are not set as the default search engine. In fact, what do we say every day? Hey, Google this, Google that. We don't say Bing this, Bing that, duck this, go that, right? So Google has become a part of our vocabulary, and we're so used to using Google, we'll continue to use Google. In fact, this is exactly what happened in Europe. In the EU, they forbade Google to be the default search engine on devices in Europe, right? And did that reduce Google's market share and search dominance? No, people still use Google, okay? Number one, because of habit. Number two, because Google, end of the day, produces the best search results. Because at the end of the day, the search algorithm depends on the data. The more people use Google to search, the better their algorithm gets at searching. So Bing and DuckDuckGo or whatever, Yahoo, they are far behind in terms of their search results. So people will still use Google. So that's why I'm not really concerned. Now, the third thing that the Department of Justice can do is they could force Google to break up. So break up into what? As you guys know, Google, well, actually Google is one part of the company. The whole company is called Alphabet, right? So Alphabet owns Google, they own YouTube, they own Android, they own Chrome, okay? So what the worst thing that the Department of Justice can do is to force Google to sell Android, to sell off the company and to sell Chrome. That's the worst thing they could do. Now, if that happens, is that good for us as shareholders? Yes, that's fantastic. Why? Because now from owning just a share in Alphabet, once they break it up, we will also own shares in Android, which will be a separate company, and we'll also own shares in Chrome, which is a separate company. So now we'll own shares in many companies, and the likelihood is that the value of the parts of the company will be worth more than the whole company. It is always like that. In the past, whenever a company breaks up by choice, not by force, whenever they spin off their subsidiaries, value is unlocked. And the shares of the different parts will be worth a lot more than before the split up. Now, I must tell you that the chance that the government succeeds in getting Google to split up is very, very unlikely. Very unlikely. There's more chance of me being gay or turning gay than that happening, all right? And in the very unlikely event that it happens, and I go up the Brokeback Mountain, I can tell you that Google shares will probably pop up 20%, okay? Now, what's interesting is that if you look at Alphabet shares today, I like to call it Google, but it's actually Alphabet, right? If you do a valuation, you'll find that it's actually the cheapest, one of the cheapest of the Magnificent Six stocks. Now, those of you who are my students who have enrolled in my Whale Investor course and you've got this intrinsic value calculator, you can do your own calculation and see for yourself, right? So for example, right now, Google has a free cash flow, latest free cash flow of $60 billion, $67.87 million, right? So put that in, $67.87 million. That's their free cash flow for the last 12 months. And then you put in their total debt, which is their short-term debt and long-term debt, put in the cash and short-term investments, which is $100 billion. Now, what is the growth rate we're going to use to project this free cash flow generation into the future? Now, again, if you go to Finviz, for example, you can see that for the next 5 years, they're projected to grow at 20.5%. The last 5 years, they grew at 21%. Next 5 years, projected to grow at 20.5%. Oh, by the way, don't forget that Google also owns Google Cloud, which is now turned profitable and accelerating in terms of its growth. So that's another subsidiary business that adds on to their bottom line. Okay, so if you put 20.5% as their growth for the next 5 years, and then 15% for the following 5 years, which is what I normally do, and then 4% for the last 10 years, and you put in the number of shares outstanding, which is 12.37 billion, and I'm using a 5.7% discount rate. Now, some of you have asked me in the past, Adam, for the discount rate, why don't you use the weighted average cost of capital, like what they teach us in CFA? Well, what you learn in CFA is when you do the discounted free cash flow valuation, you will project the cash flows to perpetuity. That means you assume the company lasts forever and you add in what we call a terminal value. And that's when you use the WACC, the WACC. But for me, I'm very conservative. I only assume that the company will last for 20 years and die. So anything beyond 20 years is a bonus. So because I only project the cash flow for 20 years, I have to use a lower discount rate than projecting to perpetuity. Instead of using WACC, I use the cost of equity as my discount rate. By the way, in case you didn't know, Warren Buffett actually uses a 10-year treasury yield as his discount rate in valuation, which is even lower. All right. So anyway, putting in the numbers, what do we get? We get an intrinsic value for Alphabet or Google at $237 intrinsic value per share. And based on the latest share price of 162, Google is cheap. It is undervalued by 32%. So why is Google so cheap? Because of this uncertainty that, what if they get broken up? What if they get sued? So all this uncertainty is already priced into the stock. Okay? So again, if they don't get broken up, then Google will go a lot higher. And even if they do get broken up and I go up the Brokeback Mountain, it'll be worth more anyway. Right? So because of that, I'm holding my Google position. No worries. Stay invested. And may the markets be with you. I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.